But Rajesh Bhatia joining in. He's Chief Investment Officer at ITI Asset Management on Talking Point this morning. Rajesh, great to have you on the show as always. Thank you so much for coming in. Just wanted to start off with getting a sense of, is the worst over? Are there signs that the worst is over as far as Indian markets are concerned? Because the worst that could have happened is done. I'm not saying that things are changing, but on the India-US trade deal, I think लोगों ने उम्मीद ही छोड़ दी है कि कुछ होगा. So from that point of view, we're starting off Q2 and it can't be as bad as Q1 is. So from that perspective, is that a way to look at the markets right now?
From an economic momentum perspective, I can't say that the worst is over. I think if the 50% tariffs do last, there are implications for the economy. Let us say there will be pressure on the macros. The current account deficit, the capital account deficit, it will definitely be a deficit. There will be challenges as far as the rupee is concerned. There will be a fear of investing. So I think that investments will probably slow down as well. I'm talking about corporate investments will slow down as well. FIIs will be less inclined to invest in India. The growth rates of the GDP will certainly come down. There will be losses in the employment of the textile sector. Of course, it depends also on what the government does as a reaction to that. You could have more NPAs in SME, MSME, etc. So if the tariffs do last for longer, then I think there are economic implications of that which probably are not all priced in. So there could be a little bit more trouble for earnings growth trajectory as we anticipate as you move forward. Having said that, I don't think there are going to be massive macro imbalances. Look, every time a very large correction takes place in India, it's caused by macro imbalances. I don't think you're going to see any major macro imbalances. So my sense is that the downside also will be reasonably limited. And of course, there is elapsation of time as well. So to answer your question, no, the worst is not necessarily priced in if the tariffs kind of remain. But I don't think there's too much downside. Maybe the upside will get capped for some time.
Okay, so fair assessment over there, and I think very practical, clear-eyed assessment of what is happening, because we don't know. It could get worse. Then let's look inward and domestically, what we do have in our realm of comprehension in that sense. And let's start with results, kicking off with TCS today. What are the key points that you are looking out for, Rajesh?
So look, as far as IT is concerned, I think there's probably been people have given up on IT. I think so. My sense is that there is very little expectation. I think Accenture also told you that the next 12-month growth rate are not going to be great. So nobody is really expecting too much in terms of growth rate acceleration as you move forward. The only good thing about IT stocks is that the valuations and the where they are relative to the rest of the market, they are probably at a very low point of enthusiasm. So even marginal gains or marginal surprises can definitely give a reasonable result. Not an outstanding result, but a reasonable result. Look, these companies are high free cash flow generating companies. They'll give you about 4% type of dividends. Even if a 8 or 10% earnings upside takes place, and there is a re-rating of even 10%. So the PE goes from, let's say, 20 times to 22 times. Voila, you'll have a 4% on dividend, 10% on earnings growth rate, and 10% upside on the PE re-rating. You'll certainly have a 24% upside. So the expectations are so low from these companies that even a marginal rise in expectation can reasonably give you a good return as far as TCS is concerned. But the entire theme, I think, out of this will be, my sense is that a lot more focus of investors has been on domestic facing companies. And I think a lot of people would want to understand, are the GST cuts in consumption a one-time effect, or do companies expect a multi-year demand acceleration, so on and so forth. So I think there are many other questions in the earnings season, but to answer your question on TCS, from the IT perspective at least, the expectations are really low.
Got it. Rajesh, what gives then? I mean, would you be if you had a chance to take a cash call, considering your opening answer, would you sit on a bit of cash or would you invest? Clearly, you're not very gung on IT, etc. and stuff like that. So would you be fully invested or majorly invested? And if so, how are you picking and choosing? Where do you put your money to work?
So, Neeraj, this is a fairly binary event. If the tariffs were to go away, there would be, I would say that markets can go 5% in 1 month. Right? In fact, you saw a glimpse of that in September. Remember, the market was up close to 5% and then gave up all its gains. It was up 5% because there were suddenly noises from the US saying, from the Trump administration saying, India and US are friends, Modi and I are friends, and so on and so forth. So suddenly people thought of that as there is a resolution coming in November, and the markets went up 5% to that effect. So if the tariffs were to go away, it's a binary event. Then my sense is there will be acceleration and risk on as far as Indian markets are concerned, because you already have the effect of 100 basis points of cut in interest rates, GST cuts, the 12 lakh income tax effort. And my sense is as you move forward, regardless of what happens to tariffs, I think the government is going to be far more reform oriented as you move forward. So all of that can bode well for India. Having said that, to answer your specific question, we are advising people to be more in hybrid schemes so that there's a adequate risk return capture in those kind of products. So if somebody has only a equity call or a cash call, it may not be harmful to have some cash in your portfolio.
Okay. Rajesh, the other thing is this pivot towards consumption, and which is fine, needed as well, and hopefully will work for the economy. Does that leave Capex plays out in the cold, or are there select Capex plays that you guys believe, because they are off from the meaty valuations that they used to trade at, that could be worthwhile to look at from a 6, 12, 18-month perspective?
So the energy in the Capex plays is in defense, although not fairly valued. It's in defense, it's in T&D, transmission and distribution category. So there are electronic manufacturing services. So there are some elements of capital expenditure plays in those categories where there is enormous focus. So those, I think, it has become a lot more stock specific in that category rather than a more broader approach what we saw from, let's say, 21 to 23, 24. So I think it's become a lot more category specific in that capital expenditure play.
Okay, I'm wondering in terms of pharmaceuticals, Rajesh, again, that's in the realm of news coming from the United States and then reactions over here. But the decision on generics seems sensible, even though belated. This is a space to build up on, because here the balance of power in that sense sits with the manufacturers in India.
Look, the growth rates in this business, despite the good news that you saw today that has come in, are still going to be, fairly modest. Now, if you really want to play the India growth story, my bet is really on the digital play category. Look at quick commerce. Look at payment platforms. Look at insurance intermediaries in the digital platform. I think this category is really where the wealth creation is very conspicuous and the growth rates are very, very reasonable to higher. And that's really where the excitement as far as the Indian markets today are concerned. Look, these companies have gone from narrative stage to a fast growth, proven business model stage. There is, at some level, ebbing of competitive intensity, and my sense is that scale is going to really give you the wealth effect. So I feel that digital plays are really the ones where a lot of action is, and that's really where the focus should be.
Well noted. Rajesh, take a moment to thank you for joining in today and giving us your thoughts. Really appreciate your time this morning on India Market Open on NDTV Profit.